for the very latest.
What up, Instagram, TikTok, Twitter,
world,
Facebook? Listen to the sound of my voice. I have a cool way for y'all to get free merch from us and support the channel at the same time. But this is what you got to do. All you got to do is, first of all, subscribe to the channel. Click. Don't cost you no money, right? Just click. Hit the bell.
Yep.
Free, right? That's step number one. Step number two, leave a comment. It don't matter what you leave. It could be the letter C. It could be the fire emoji. It could be the crown. Whatever emoji you want to leave on there, just leave an emoji. Step three is up to us. All we're going to do, we're going to put you on the drawing. Now, listen, you can put your name on as many videos as you want. The more videos you leave a comment on or emoji, whatever you want to leave, the more times you get added in the drawing. Right? We're going to draw your name and we're going to send you the merch. Simple as that. Real easy. All you got to do, follow those steps and we will send you some merch. All right?
Subscribe for the very latest.
They wanna kill me cause I'm black, but they can't kill me cause I'm black. I'm every color on the palette, my footprints, the first to ever step on the map. And I know where I began, so I overstand where I'm at. I'm your highness, the highest title, numero uno. You can't degrade me, can't deflate me. You still segundo, you will not push me out of my circle. This ain't sumo, my culture is universal. From the third rock to Pluto, influential, was instrumental in the development of anything relevant that advanced our intelligence, created from the elements, birthed from the earth. It's a cycle, time lapse, I return to the dirt.
I want you to tell people how corporations use life insurance. How do banks use life insurance? Because from what I understand, all employees, all the corporations have life insurance on every employee, right? And they make money off every employee through life insurance. And I think mainly I'm thinking about banks. You know anything about that?
I don't. I'm gonna have to research that. Now I do know that you have like a key person insurance you can do on like the key person, like the CEO, CFO, stuff like that. You know, hey, their contribution to the company, we want to replace that. If they pass away, we need to replace them, or find somebody to replace them. Or if they were, you know, like the courtroom, all you guys are co-owners, and if you wanted to buy out the family so that person passed away, you can do that, you know, stuff like that. Like I said previously, banks use it for investments because they do know that insurance is one of the oldest used investments, because if you look at financial services, it builds the most millionaires. You know, anybody's in it, so they know that, you know, everything's backed by insurance because of how it's regulated. Not being in the stock market, not losing value, holding its assets and stuff, billions of dollars in assets. But the main thing I want people to know was the infinite banking. That's the biggest thing that I keep getting asked. You know, y'all had came to me. That's it, and it's a really good tool. It's just that it costs. But the savings for it is a high savings. So
you said infinite banking.
Infinite banking.
Okay.
For infinite banking, because it's basically be your own bank. Because when you go to your savings account, let's say you have $10,000 in savings, and you decide to pull $5,000, what are you left with in your savings account after you pull your $5,000?
Which if I had 10,
Yeah, 10.
5?
Yeah, you'd be left with 5, right? And then
Mhm.
you won't get back to 10 until you put that 5 back.
Right.
You know? Well, in insurance, if you have 10,000 in cash value, you pull it out 5,000. Your 10,000 is still growing. Because the 5,000 is the collateral. The 5,000 is your death benefit. So if your death benefit is 50,000, then it goes from 50 to 45. And if it isn't paid back, then your family just gets 45. But the 10,000 is still growing, so you're able to borrow more against it as it continues to grow and the interest and dividends pay out. So that's the concept of infinite banking. But again, 10,000 is enough money to go help your business, put some money in your business, go buy real estate. So people are putting 20, 30, 40, 50 grand or more and starting off doing that. Or they're investing $800,000, $1,200 a month to build it. So it's a heavy investment, but a lot of us don't have that yet. So go ahead.
So you're borrowing, because I remember they was telling me about this, Ricky.
Yeah.
Now I wasn't getting this kind of game from them, but my brother-in-law, he was telling me about infinite banking, in the sense because you're borrowing the money from your policy, if I'm not mistaken, right? So if you, I'm just going to make it clear, if you have $100,000 policy and you take out 10 grand, if you RIP the next day, that's 90 grand that goes to whoever the beneficiary is.
Right.
Because I already earned up that 100 grand. I just saying I can't take it because I ain't passed, or I could take a certain amount of it because at the end of the day, it's still my money because it's on me. I'm the bank at the end of the day.
Right. So when you look at, the thing about the cash value, it has to build. So if you're starting monthly, then it's building. If you throw in a lump sum, then you can take out a certain point. So like I said, I'm learning how to structure them because people are asking. And I'm gonna tell you why I'm just now learning versus when I did what I usually help people with. So there's a guy that I met at a seminar, and he was talking about infinite banking. So I want to hear from him. He played 3 years in Major League Baseball. Retired, invested in real estate with his money.
He got money.
That's the thing. He got money. So invested in real estate, storage units, things of that nature, passive income. Started selling and getting in medical sales after he got out, and then somebody taught him about infinite banking and putting money into insurance. So he started doing it. So this is his strategy. So first off, his clientele's up here, right? The 1%ers and all this other stuff. So he says, let's say he's looking at a project, $1 million project, real estate project, $1 million. They need 20% down, $200,000 down. He's looking for investors. Somebody says, hey, I want to invest. They have $100,000 to put towards the 20%. They get $100,000, cool. First question he's asking, where you got this $100,000 from? Oh, it's in the bank. So you got this $100,000 sitting in the bank. They using that money and making off. Why don't you put it in insurance? And that way you're able to make money and be your own bank. So what has he done? He's made a sale. That's the first thing. So you put the money in, let's say you put $100,000 in, the next day or 15 days, I don't know how soon, he's able to pull out $60,000. So you get he put in 100, but he's only able to pull out 60. But he needs 100 for this investment. I was like, then, because that's what I asked. I said, he still needs 100, so where's the other 40? He's like, do you think this $100,000 that he just gave me is all he got? Like, you're right. He got more. Right. So he's going to pull it from that price, say his savings account, to make the 40 with the 60. He invests $100,000. Now, once he gets paid and all the money, he's going to throw it back in his insurance and it builds back up. And now he's able to start revolving and using that money versus and pulling and it's gaining interest and all that. But again, that's the 1%er who got 100,000, who got 50,000, that many. So when I
play,
So when I asked him, because I get people, I tell them between $800 to $1,200 or $10,000 to $20,000 just to start. He said, yeah, that's about right. And I said, I got a lot of people, they say they only got like $100, $200. It's the same mentality from back in the day. Oh, I just give them a turn. Like, and then those people are the hardest to deal with because, and you talking about my people though, because they don't understand. Right. It's a mentality. Like I said, you're trying to break this mentality, but they only got, and he said they're the hardest to deal with. They always don't, they miss the payments and all this other stuff. They can't. I mean,
it's so true.
But that's the majority. That's the majority. And so, because my industry is white, male dominated, late 40s, 50s, who's speaking to us and who's going to deal with us? Us. So, exactly. I had somebody that still ain't paid the insurance, and I done drafted it 3 times. I'm like, I guess you don't want it, but no, I want it. Look, man, we gotta come down to something. I kind of tabled it. I don't know. I really don't know what's going on. But I'm gonna get on this week. But it's honestly, it has been a headache. But I know I try at least 3 times to get this policy to get placed. But again, the reason. And another question I asked them. So I want to talk to y'all about 2 different permanent policies. You have whole life, which everybody knows about, and you have index universal life. They're both permanent insurance, meaning, hey, this policy is going to pay out when the person passes away. Now, whole life is your cash value is fixed, meaning anywhere between 3 to 4%, and that's why I want to get confirmation on, because whole life and fixed rates have went down, just like CDs at banks went down. Same thing with whole life. It used to be in the 6-7%. So I wanted to ask you, I had to have another high yielding whole life product for this infinite banking to work. And he said, no, mine's get about 4%. So that confirmed that I can do the same thing. And that's why I said, okay, now I can start learning, because I didn't think my products were good enough. Because we're with over 15 different companies, but all their whole life wasn't great. So with the index universal life, it's from 0 to 12%, meaning, and it's tied to the market. So the market is bad, you may get 1% that year or 0. But when the market is great, you may get 8%, 10%. So here's the key difference. Before I let y'all go, because I know it's getting late over there. But key difference. So I'm gonna ask Walt this. You have a death benefit and you have your cash value, right? Now keep it simple. You have $100,000 of death benefit, because like I said, if you borrow against your cash value, let's say you have $50,000 of cash value, you borrow 20 of it, that $50,000 is still going to grow. If you pass away, the $100,000 goes from 100 to 80, right? Okay. All right. So let's say you don't use any of your cash value. You was waiting on it, like I'm trying to get to a certain number, then I'm going to pull it out. But something happens, boom. Beneficiaries, should they get the $100,000? Well, how much should they get if they have $100,000 of death benefit and $50,000 of cash value? How much should the beneficiary get?
150.
Saying
150.
150. Okay, Walt said 150. Okay, and whole life they get 100, because that's the agreement that y'all signed up for, and the death benefit is 100,000. So if you don't use the 50, it's gone.
Okay.
Now, in the IUL, you pay a little extra price. So maybe at the same rate, the cash value is not 50,000, maybe it's 47,000. But at the end of the day, you don't use the 47, you pass away, your family gets 147,000. Because if you use all 47,000, your death benefit is 100. So your family gets 100 versus in a whole life, you use all 50,000, you don't pay it back, you pass away, that 100 becomes 50,000, your family gets 50. So that's the key difference in why I personally like IULs, because of that fact, because I never know when I may pass away, and I'd rather pay the extra fee and get all my money versus
IUL stands for
Index Universal Life. So that's only, so I'd rather pay the extra fee, and the guy said he didn't care for them because IULs, to Clint's point, do have a bad rap if it's somebody unexperienced that doesn't structure it properly, because they can structure it and it lapses. at age 80, 90 if they don't fund it correctly. So we have to let the client know this is something you're funding. So if you're starting at $200, the max you can put into is $800. Are you looking to hit that number? Do we need to decrease it? So we need to know what's the max amount you're going to put in that policy. So for the folks that are looking to do $800 to $1,200 a month, maybe they can't do it now, but maybe they start a business and they can fund it over time, but they're going to start at $200. And they can go from 200 to 4 to 8 and get there, but maybe just not today. So it's more flexible than just a set premium with the whole life. You have to pay that amount. We structure for $850, you got to pay $850 today. Versus, hey, the max I want to put in, I think I can be able to put in from my business is $1,000, but right now I can only put $400 a month. Okay, we're going to structure it, and so forth. And then that way it's compounding still, and all the money that's in the cash value and the death benefit is together. So when you pass away and you don't use it all, it just goes to your family. If you use it, it's just deducted. Same as whole life. But you just got to make sure the person you sit with will structure it correctly, because if not, then it could lapse and then you're left with no insurance. So that's the bad rap that the IUL will get, versus the whole life we know it's going to be there as long as you pay that premium, because it's fixed. You pay this $850, it's going to do what's going to do, regardless. So you're going to pay $850 a month. With the IUL, you pay $400 and you pay $400 for 20, 30 years, and you're supposed to be increasing it as an investment, then it's not going to work like we told you back in 22.
Subscribe for the very latest.